Are you a US resident for tax purposes? It sounds like a simple question, right? But the answer can be incredibly complex. For foreign nationals, it pretty much all comes down to one thing: the substantial presence test. Now, the best way to think about this is like it's a calculator. You punch in your days of physical presence, and it spits out an answer: resident or non-resident. So in this explainer, we're going to deconstruct that calculator piece by piece and see exactly how it works.
Here's how we're going to tackle this. First, we'll look at the big question: resident or non-resident. Then we'll dive into the math, the 183-day formula itself. After that, we'll cover the exceptions, the days that surprisingly don't count. We'll also look at a special escape clause. And finally, we'll wrap up with why all of this is so incredibly important.
All right, let's get right into it. Before we can understand the calculator, we have to understand what it's calculating. This is the fundamental question that the IRS is trying to answer.
And this right here is why it all matters. Look at the difference. If the IRS calculator labels you a resident alien, you get taxed on your worldwide income, all of it, just like a US citizen. But if you're a non-resident alien, you're typically only on the hook for taxes on your US source income. I mean, the financial difference between these two categories is just massive.
So you've got two main ways to end up as a US tax resident. The first one is super simple: the green card test. If you have a green card, you're a resident. End of story. But the second path, the substantial presence test, that's where it gets interesting. It's not about your immigration status, it's a pure numbers game. And that's the calculator we're going to break down today.
Okay, so let's pop the hood on this thing and look at its core engine. This is the 183-day formula that drives the whole process. The test is really a two-part process, and you have to meet both conditions. First, you have to have been in the US for at least 31 days this year. Think of that as just a basic entry ticket. If you pass that, then you move on to the main event, the 183-day calculation, which looks back over a 3-year period.
And here it is, the formula itself. Now check out those multipliers. You count all your days from the current year, but you only count 1/3 of your days from last year, and just a tiny 1/6 from the year before that. The message from the IRS is pretty clear, right? They care a whole lot more about how much you've been here recently. Okay, let's run an example to see how this works in the real world. Imagine someone spent exactly 120 days in the US in 2024, 2023, and 2022. Seems like a lot of time, right? But are they a resident? Let's plug it into the calculator and find out. So, we take the 120 days from this year, 2024, and multiply by 1. That gives us 120. Then we take the 120 days from last year, 2023, times 1/3, that's 40. And finally, the 120 days from 2022 times 1/6, which gives us 20. You add those up, 120 plus 40 plus 20, and the total number of testing days is 180. And there's our answer. 180 is less than the magic number of 183. So this person is not a US tax resident for 2024. I mean, look how close that is. It really makes it seem like every single day counts. But does it? Well, this is where we get into some of the really crucial, non-obvious details of this whole system. Because it turns out the calculator has filters. Not every single day you spend in the US actually gets counted by the formula. That's right, the IRS has rules that explicitly exclude certain days. For instance, if you get sick while you're here and can't leave, those days don't count against you. Same thing for certain NATO personnel. But the biggest and most common exclusion is for a special group of people called exempt individuals. So what is an exempt individual? Well, it's basically someone who has a special pass. They're a temporary visitor, and their days in the United States are essentially invisible to the substantial presence test calculator. For them, the clock just isn't ticking. And this is super specific and actionable stuff. If you're a student here on an F, J, M, or Q visa, or a teacher or a trainee on a J or Q visa, or maybe someone here with a foreign government on an A or G visa, your days here just poof. They don't get added to the formula. Now here's the catch, and this is a really important detail that a lot of people miss. These exemptions don't last forever. For example, with the student exemption, it generally runs out after 5 calendar years. This is a critical rule that stops this exception from becoming a permanent loophole. Okay, but what if you do the math? You count all the right days and you pass the test, but you know deep down that your actual life is still based in another country? Well, the calculator has one last feature for you. A kind of manual override switch called the closer connection exception. I bet this hits home for a lot of you, right? You might have spent enough time in the US to technically trigger the test, but you know for a fact that your real home, your family, your main job, all of it is somewhere else entirely. Now, to use this override, you have to meet 3 specific conditions. First, you have to be in the US for less than 183 days in the current year. Second, you have to maintain what's called a tax home in another country for the whole year. And third, you have to prove you have a closer connection, economically, personally, to that foreign country than you do to the US. And that term, tax home, can be a little tricky. The IRS doesn't just mean the house you live in. It's your main place of work, your center of economic gravity. It's really all about where you have your most significant family, personal, and financial ties. This concept is the absolute foundation for making a closer connection claim. So we've taken the whole calculator apart. We've looked at the engine, the filters, and the override switch. Now let's talk about the final output and why getting this calculation right is so unbelievably important. The consequences are huge. Once you become a US tax resident, you have to start paying US taxes on your income from everywhere in the world. You also have to report your foreign financial assets. And get this, if you're a long-term resident, you could even face an exit tax when you eventually leave the US tax system. The stakes are just incredibly high. And there you have it. We've taken the machine apart, examined every gear and switch. You basically have the blueprint for the IRS's residency calculator now. So the only question that's left is, now that you know how it all works, what answer does it give for you?